Let's go to Caroline Woods in New York, senior markets correspondent, taking a look at some of the analyst commentary this morning. A little bit of negativity, Caroline. Interesting names getting targeted by the analysts at Guggenheim for sell ratings. I had to make sure I was hearing our producer right this morning. It was early, and I was like, sell? What? Palo Alto? CRM? What's going on?
Yeah, two big winners over the past year, and Guggenheim is turning bearish on both Palo Alto and Salesforce. Starting with Palo Alto, Guggenheim downgraded PANW to sell from neutral with a $130 price target. It's currently trading around above 180 right now. It's down about, or I'm sorry, around 177 right now. It's down about 3%. So quite a bit of downside according to Palo Alto. Points out that it's up 40% from its February 21st low of the past year, despite the fact that it has reported several questionable quarters over the last year or more. And this is despite new ARR for the total business declining in each of the past 5 quarters. Now, this analyst over at Guggenheim says it understands investors' confidence that management will do whatever it takes to succeed as the leading market share vendor in cybersecurity. However, it says its overall business performance field checks that indicate subtle softening in momentum over the last year, and an expected federal IT spending moderation is turning them bearish. So I should note there are only 3 analysts that have sell ratings on Wall Street. For Palo Alto, 75% of analysts rated as a buy. Median price target is $212.50. So this analyst very much in the minority, and very much in the minority for Salesforce as well. One of 2 sell ratings for Salesforce now. Guggenheim downgraded it to sell from neutral with a $247 price target. It's currently trading above $330 a share, so quite a bit of downside there. Says Salesforce has not been very organically innovative in quite some time. It points out that it has rallied about 30% in 4 months since it introduced Agentforce in late August, but this analyst doesn't think that Salesforce will meaningfully monetize Agentforce unless it acquires several assets that have been doing over the past decade what Agentforce aspires to do. Also says that Wall Street is looking...
That's exactly what I was saying, is that it seems like an obvious place for them to go, but they're gonna have to, they're not alone. That's kind of the whole point of all these other startups. They're literally trying to do exactly this.
Well, maybe this analyst was tuning in and listening to you, Oliver, but also on top of that, it says that while Wall Street is looking for fiscal 2026 revenue growth of somewhere between 9 and 10%, they're expecting more like 5 to 7% revenue growth if Agentforce doesn't pan out as expected. And then says Salesforce's status as a system of record gives it staying power, but in our view doesn't give it any advantage in providing AI solutions that require dynamic data with rich context. So officially a bear on Salesforce as well. So downbeat on those 2 names. I should note, though, that they are upbeat on a few names. Well, upbeat at least on MongoDB, upgraded MongoDB to buy, and then turning more cautious, less bearish on Workday, upgraded that name to neutral. But in terms of Salesforce and Palo Alto, Salesforce essentially flat right now, but Palo Alto is taking a hit, down about 2.5%.
All right. Yeah, it's a clearly more having a bigger impact on Palo Alto than Salesforce. But, they're both huge winners off their lows from last year. So they've been part of this big embrace of cloud for AI. And the fact that this analyst is specifically targeting the competitive landscape of AI, I think is notable, because it's not just like they're saying, oh, valuations are too much, let's pull back here. I mean, this is outright disputing the narrative for probably, 2 of arguably the most important companies, Salesforce possibly the most important in the cloud space right now.
Yeah, it's certainly based on fundamentals in terms of overall business performance for Palo Alto, and then in terms of, also in terms of lack of innovation, competition, that type of thing. So yeah, certainly not a valuation call, despite the fact that both are up.
Salesforce right now, $333, ignoring the note from Guggenheim with the sell rating, though the stock has obviously got a lot to work with, up 27% in the last year. That figure kind of obfuscates the real rally, which was upwards of 70% from the lows from the June earnings in Salesforce late May all the way up into the high from the last earnings. So both the summer earnings and then the winter report kind of bookending that rally. This Boeing note deserves a little bit of attention, something slightly more positive. And, Boeing's actually had a decent run to close out last year, Caroline. What's this analyst saying?
Yeah, but still the worst performer in the Dow for 2024. And I was going to say it's the second best performer in the Dow today, but in just the past few minutes, Microsoft, Chevron, Sherwin-Williams have pushed past it as its kind of gains have moderated a bit, but still up about 1.25% today after this upgrade from Barclays, upgraded Boeing to overweight from equal weight with a price target of 210, up from 190. So the analyst thinks that Boeing could rally more than 20% from here. It is up about 1.2% today, but currently down about 31% over the past 1 year. That being said, this is the first time that this analyst has been positive on Boeing since 2019. Says the now shored up balance sheet is no longer an overhang. Says free cash flow trajectory is much more reasonable. The reset to max production sets it up to successfully ramp. And then also thinks that Boeing's new outside leadership can affect meaningful change that's necessary. In this note, which was titled Darkest Before Dawn, the Barclays analyst said, "We think upside for the stock now mostly relies on sustained positive momentum for production and deliveries, which we believe Boeing is poised to demonstrate in 2025. While we don't see an overwhelmingly compelling upside case on typical valuation metrics, we believe positive momentum on production, deliveries, and cash can carry the stock higher." There are some risks to this analyst's outlook, though, including timing of regulatory approval for a production cap, as well as any further delays of certification to any Boeing models. In that case, the analyst says the stock could fall more than 25% over the next 12 months instead of gaining more than 20%. But obviously, that's not the base case. Should note, Barclays is now joining the majority of analysts. About 57% of analysts on Wall Street have a buy rating on shares of Boeing. The median price target is $200, so Barclays is higher than the median at 210, but the street high is 250, so not quite at the street high. Boeing shares up about 1.3% right now, off earlier highs, but still positive today.
All right. Boeing with a nice little momentum here in the last couple of weeks, but still a lot of pressure it's got to work off. So $210 would be a nice pop, though, so maybe we'll get some momentum in 2025. Hopefully things will go smoothly for the company. Thanks, Caroline.